Hey guys, Adam here, AggressionTrader.com. Let's do our wrap up for today. It was February 9th, 2015. A little bit quiet here. It's a Monday. We expect it to be a little bit more quiet, but today was on the unusual side. Now, here in a little bit, we're going to talk about something over here on the right side. Normally, you see me having like a smaller tick chart over here on the right. I put up a 2-minute time frame chart over here with some volume down here. We're going to cover that and just illustrate what I see as low volume versus good trading volume and so on and so forth. Today was absolutely way on the low end. But let's go over what we talked about this morning, our game plan for the day, what we did to implement the game plan, and how it all went. So, to start off here, we always start over here and look at our longer time frame. Basically, look from the top down. You can see that we came up to our daily resistance over here. This is a daily chart, but we came up to the resistance here on Thursday. Friday was just kind of an interesting day. It's a doji, if you were to look at candlestick patterns. So very typical day for the dailies being here at the resistance. So today, what had happened was the market had traded, it closed up here on Friday. We actually opened a little bit lower. So we had what you would call a gap down this morning. So initially, our game plan was one of three things. Either A, which was our number one, hopefully this market traded up nice and slowly, and then we was able to pick up some steam and sell off for the rest of the day. That was option number one. That was our game plan going forward. And if you were watching the markets live this morning, watching these indexes, you know this is exactly what has taken place. But option number two, in a situation like this, when you gap down, you're either going to gap down and you're going to keep on running. But with this number two, you need lots of support from your indications down below, your market internals. Say a net issues here, maybe gap down minus 1,200, and then keep on trading lower in a situation like this. That way it shows to you that the sellers have kicked in and it is not even going to think about popping up towards that previous day's close. And then option number three would be if it closed here, opened up lower, and then started to slowly. The reason I say slowly, because look at this daily chart. If you put volume on a daily chart, it grinds its way up. Even though they had some big bars, they were before the market, but the market grinds its way up, high volume sell-off. Grinds its way up, high volume sell-off. Grinds, and so forth. So typically, if we were to see this option number three, we were going to see the market grind its way up. Probably wouldn't get too active in the market simply because we're at the resistance already. So it's a little bit risky, and it could have rolled over at any time. So option number one, it was, obviously we were going for, but we had some other options. Now, if you pull up this chart, let's just look at this. Let's just pull this up here. Here's where the market opened up at. Here is the 8:30 time frame. What did we say? We had a close higher. We opened up down here much lower. We were looking for this market to slowly grind its way higher. And as it did, look for some speed, some selling speed moving forward. That's exactly what we waited for. That's where our trading came. Now, you can't see the trades on this particular chart. I'll pull up the 2-minute part here in a second. You'll see them. We ended up taking one winner to this morning in the Dow. The reason we chose to use the Dow originally was because the Dow broke down below the previous day's lows, and the S&P and the Russell had not broken the previous day's lows yet. So basically, the first choice to take the Dow rather than the S&P was simply because the Dow had broken the previous day's low, and it was the path of least resistance, meaning it had already broken through that support, and we didn't have anything to worry about, and it was a little more free to drop at that point. So that's the reason we chose the Dow originally for our first trade for that small winner, and then we went on later after the S&P dropped down below the previous day's low. We took two more positions basically for a scratch. One was a scratch, one was for a tick, and basically we saw the market not going anywhere. This low volume, absolutely no participation. We just went ahead and got out of them positions. The market chopped sideways for a little bit and then eventually turned the other way. So, and as you can see here, eventually just kind of popped higher here into lunch. And then into lunch, we were talking in the trading room. Going into lunch, I said, guys, the only chance I'm going to get to trade this market would be if the volume picked up and was to the downside. The reason I say that because volume's really not going to pick up if this thing heads higher. It's just going to grind higher, and there's lots and lots of resistance to grab us up here. If we get some good quick selling, which we didn't, it was a slow sell-off, I would have been willing to look to the short side, but needless to say, the volume has been low, and let me go to that point here. While we're getting a little bit long-winded here, let me go ahead and pull up this 2-minute bar. You can see the two positions we took today in the S&P. Not a big deal. We had one scratch for a break even, no money there, and then +1. So we scratched out of both these, made some small profits on the Dow early on, but just one of them days. But what I really want to show you on this 2-minute bar, if anybody's ever curious, I've had some questions recently about volume and what's good volume, what's bad volume, and so forth. A really easy way for you to gauge this, just pull up the S&P, guys. Just pull up an S&P, a 2-minute chart, and put some volume on it. Now, my rule of thumb, I hear a lot of people say, well, at least have 4,000 or 5,000. My rule of thumb is have 6, 7, 8 minimum. Okay, so let's say 7,000 to 8,000 contracts traded every 2 minutes. That's a nice rule. If you can have that, then you probably have some pretty decent trading going on, some decent volatility. You start tinkering below 7,000, you get down in the 5,000, the 4,000, and even lower, it gets pretty thin, and it becomes one of them deals where you're sitting here watching paint dry, and it becomes very boring, and it will tend to lead to overtrading because you're trying to force an issue rather than having something come to you, and it just never leads to anything good. So for you guys who have written me and aren't in the trading room, this morning we covered this. I've gotten, some reason this topic has come up here recently, but if you're just a watcher of the videos, just put in a volume chart here. Underneath a 2-minute time frame, and try to, for good volume, I like to say 6 to 7, maybe 8,000 plus. That would be good trading volume. Good contracts traded every 2 minutes. You get down below 6,000, that gets pretty slow, and especially if you get below 4,000 or 5,000, it gets even slower and even tougher to be patient here and watch this market. But even if you look over here, just to look at this chart, you can see. If I put my cursor here somewhere in the mid, you're seeing right here in the middle of the day. Actually, let's even go back to this morning. This is 9 o'clock this morning. The mid of these volumes is somewhere around 5,000. And if you were trading this morning, you know how crazy slow the market was. And then after we went into lunch, we were talking about the averages being down here around 28 to 3,000 contracts traded every 2 minutes. That is very, very low. That's pretty slow and very tough for some people to stomach whenever they're trying to be actively trading. So try that out if you guys are curious about bottom. But that's it for today, guys. Going into tomorrow, I am going to look for some more selling. If we can get down below the previous day's lows, look for some more selling here. Look for that pullback on the daily chart. Over here is the daily chart. Look for that pullback on the daily chart. We're going to be bumping our bottom here around these midpoints. It's going to be very, very interesting. But any type of sell pressure, I'm going to be actively selling. I'm going to be a little bit cautious to the long side here. Simply selling the highs and buying the lows. Pretty straightforward stuff right now as far as the indexes go. So that's it for today, guys. Kind of an update. Hope you guys, hope that helped out some of you guys with the volume. But if you have any questions, get a hold of me. Adam@directiontrader.com, or you can leave a comment below this video. I am the one that responds to them, so that's a real easy way to get a hold of me as well. Just leave a comment below. So that's it for today. Thanks for watching, and I will see you in tomorrow's video. Have a good afternoon.